A cow generates about 8 gallons of milk a day. You could sell every single drop of it and still lose money doing it. That's not a hypothetical, not a worst-case scare number. That's the actual math for a huge share of dairy farms in America right now in a normal year doing everything right. Picture the version you've seen in every commercial for butter and cheese. Red barn, green hills, a handful of cows grazing at sunset. A farmer in worn boots walking the fence line at golden hour. Wholesome, slow, honest work for honest pay generation after generation. Here's the problem. Almost none of that is how this business actually works. That image is the illusion, and the real dairy farm underneath it is one of the thinnest margin, most exposed operations in American agriculture. A business that looks pastoral and runs like a commodities trading desk with livestock attached. Start with the size of the thing because the scale here is genuinely staggering. The U.S. dairy industry moves somewhere around 220 billion pounds of milk a year. That's roughly 25 to 26 billion gallons, produced by about 9 million dairy cows spread across nearly every state in the country. Farm-level cash receipts from milk alone run somewhere north of $40 billion annually, and the broader dairy supply chain, processing, retail, exports, pushes total economic activity into the hundreds of billions. Now here's the undercut, and it's a brutal one. Net margins for the average dairy operation sit somewhere between 2 and 6% in a decent year and go negative in a bad one. Not 20%, not 15, somewhere between 2 and 6. You are running one of the largest food categories in the entire country on a margin that a mid-size restaurant chain would consider embarrassing, and unlike a restaurant, you can't just close on a slow Tuesday to control costs. The cows show up for work whether the math works or not. Here's the part that should really bother you. Those numbers have been trending the wrong way for 2 decades. The number of licensed dairy farms in the U.S. has fallen by more than half since the early 2000s, while total milk production kept climbing. Fewer farms, more milk, bigger operations absorbing the ones that couldn't survive on that 2 to 6%. That's not a declining industry. That's a consolidating one, and consolidation has a way of quietly deciding who gets to stay in business and who doesn't. And dairy farm isn't one business. It's at least 3 completely different financial animals, all wearing the same overalls in the same commercial. There's the small family operation under 200 cows, often a couple of generations working it together, milk sold through a regional co-op, razor-thin margin, surviving on a scale it fundamentally doesn't have. This is the version in the ad, and it's also the version disappearing the fastest. There's the mega dairy, 2,000 cows and up, sometimes north of 10,000, run less like a farm and more like an industrial processing facility with a feedlot attached. These operations have the capital to negotiate better processor contracts, invest in efficiency technology, and absorb 3 or 4 bad months in a row that would sink a smaller neighbor outright. And there's the specialty tier, organic, grass-fed, on-farm processed, direct-to-consumer through farmers markets or subscription delivery. Fewer gallons produced, but 2 to 4 times the price per gallon if the branding and the story land with consumers. Same word on the sign as the other two, completely different financial personality underneath it. So what does it actually cost to open the gate on any of this? Land first. And this is where the fantasy starts costing real money. A working dairy operation needs somewhere between 2 and 5 acres per cow for feed production and manure management, depending heavily on region and climate. For modest 200 cow start, that's easily 400 to 1,000 acres. At $3,000 to $12,000 an acre, depending on where you're buying, you're looking at $1.2 million to $12 million just in dirt. And that range is doing an enormous amount of work, because location swings this number by an order of magnitude. Then the cows themselves, which are not a rounding error. A productive dairy cow already bred and producing runs $1,800 to $2,800. For 200 head, that's $360,000 to $560,000 before you've milked a single one of them. Then the infrastructure, which is where most first-time buyers dramatically underestimate the number. A modern milking parlor, the actual mechanical system that extracts, cools, and stores the milk, runs anywhere from $500,000 for basic setup to well over $3 million for a rotary parlor built for a large herd. Add barns, freestall housing, manure lagoons or digester systems, feed storage silos, and you're stacking another $1 million to $4 million on top of the parlor alone. Add equipment on top of that, tractors, feed mixers, manure spreaders, silage choppers, another $200,000 to $600,000. Add licensing, permits, and the environmental compliance paperwork that comes with any operation producing that much manure and wastewater. Another $50,000 to $150,000 just to get legally operational before a single truck picks up milk. And there's one more line almost nobody budgets for correctly: working capital. Even after every piece of land and equipment is paid for, you need cash on hand to cover feed, labor, and vet bills for the first 6 to 12 months before the operation finds its rhythm and the milk checks start arriving reliably. That's another $200,000 to $500,000 sitting idle doing nothing but existing as a buffer against the version of this business where something goes wrong in month 3. Total it up, and a modest 200 cow operation is a $3 million to $17 million entry ticket before revenue, before you've sold a gallon. And almost none of that gets paid in cash, it gets financed. At agricultural lending rates, which means before you've earned a dollar, you've also taken on a monthly debt service obligation that doesn't care whether the milk price cooperates. This is the moment the fantasy actually dies. The red barn in the commercial did not cost $17 million, and nobody who made that commercial wants you thinking about the number that did. So where does the money actually come from once you're operating? This is where it gets genuinely interesting, because almost nobody outside the industry understands how many layers are stacked underneath what looks like a single product business. Layer 1, the obvious one, the one everyone assumes is the whole business, is raw milk sales. You produce milk, a processor or co-op buys it, you get paid per hundredweight, which is simply the price for 100 pounds of milk. That price has swung anywhere from roughly $12 to $25 per hundredweight over the last decade, driven almost entirely by global supply and demand you have zero influence over. Here's the trap. This is the layer with the thinnest margin and the least control of any layer in the business, and it's the only one most outsiders even know exists. You don't set this price. The market sets it, and you take whatever it hands you that quarter. Layer 2 is component pricing, and this is where a meaningful chunk of real profit actually lies. Milk isn't paid for as a single flat number. It's broken into butterfat, protein, and other solids, each priced separately under the Federal Milk Marketing Order System that governs most of the country's milk pricing. A cow that produces richer milk, higher butterfat, higher protein content, can add $1 to $3 per hundredweight over a thin milk cow, even at the exact same volume in gallons. Genetics and feed science aren't a side hobby here. They're a direct revenue lever, and the operations that treat breeding like an actual research department consistently outearn the ones that just let nature take its course. Layer 3 is the cull cow and calf market, and most viewers have genuinely never even considered this exists. A dairy cow only produces milk profitably for about 4 to 6 years before she's sold into the beef supply chain. That's culling, and it's routine, not a failure. A single culled dairy cow can bring $800 to $500 at sale. Multiply that across a couple hundred cows rotating out of a herd every year, and you've got a six-figure revenue stream quietly hiding inside what looks like a milk-only business on paper. Add male calves, which have essentially zero milk value from birth and get sold into the beef chain within days, sometimes for as little as $50 to $150 a head, and you start to see the operation is actually running 2 supply chains simultaneously under one roof. Layer 4 is the one almost nobody talks about outside the industry: manure. On a large enough operation, manure gets processed through an anaerobic digester into biogas, which then gets sold as renewable energy credits or fed directly into the local power grid. A single digester system on a megadairy can generate $200,000 to over $1 million a year in energy revenue and credits alone. Waste isn't waste here, it's a second business quietly bolted onto the first. And on a gallon-for-gallon basis, it's often more profitable than the milk that gets all the attention. Layer 5, and this is the one that separates the merely surviving from the genuinely wealthy operators, is government support and price protection programs. Things like the Dairy Margin Coverage Program, which pays out when the gap between milk price and feed cost falls below a certain threshold. It's not a headline-grabbing subsidy, it's a quiet insurance backstop, and operators who actively enroll and manage it can offset a meaningful chunk of a bad year's losses. The farms that ignore it because the paperwork feels like a hassle are leaving real money sitting on the table every single year. Now the insider trick, the mechanism almost nobody outside the industry has ever heard of. It's called basis trading, and it's how the sophisticated operators insulate themselves from the exact volatility that bankrupts everyone else. The national milk price and your local milk price aren't the same number. There's a gap between them called the basis, driven by regional supply, transportation cost, and local processor demand. Sophisticated operators use futures contracts tied to the national price, combined with detailed knowledge of their own local basis, to lock in a price months ahead of delivery, protecting themselves from a sudden crash. It's not illegal, it's not even secret. It's just financially technical enough that most small operators simply don't have the time to master it while they are also, milking 200 cows twice a day, every day, forever. The farms with a person or a hired consultant dedicated purely to this hedging strategy survive downturns that quietly wipe out their neighbors. Here's the part that's genuinely a little galling. The tools to do this have existed for decades, they're not expensive to access, and the operations that use them well often aren't the biggest or the best run in terms of cow care or milk quality. They're just the ones who treated their milk check like the volatile financial instrument it actually is instead of trusting it the way you'd trust a paycheck. Now the bleed, because this is a business where time itself is the enemy, relentlessly, every single day. Cows need to be milked 2 to 3 times a day, every day, holidays included. There is no version of a dairy farm that closes for Christmas or takes a long weekend. Feed alone, corn silage, hay, protein supplements runs $1,500 to $2,500 per cow per year. For 200 cows, that's $300,000 to $500,000 annually, and feed costs move directly with commodity grain prices, which is yet another number you don't control. Labor is another brutal line item. Skilled dairy labor is genuinely scarce in most regions, and a mid-size operation needs anywhere from 4 to 10 full-time workers, at a combined cost of $150,000 to $400,000 a year. Add veterinary care and breeding costs, equipment maintenance and repair, electricity to run the cooling tanks around the clock without interruption, and financing interest on that multi-million-dollar startup debt, and you are bleeding cash every single day whether the milk price that month is good or terrible. Here's the catch nobody puts on the brochure. The cows genuinely do not care what the market is doing. They eat the same amount of feed in a $1,200 weight month as they do in a $25 one. And that brings us to the structural risk, the single domino that can take the entire operation down in one motion. It's processor concentration. In most regions of the country, a small handful of processors, sometimes literally just one, control where your milk actually gets sold. If your local co-op collapses or your processor contract gets terminated, there's often no backup buyer within economical trucking distance, because raw milk spoils fast and holding it far eats the margin alive. You can have a perfectly healthy herd producing perfectly good milk, and overnight, nowhere legal and economical to sell it. This isn't a hypothetical stress test. It happened at national scale. In November 2019, Dean Foods, at the time the largest milk processor in the United States, filed for bankruptcy. Dean Foods bought milk from thousands of independent dairy farms across the country, some of which had supplied it for multiple generations without interruption. When the bankruptcy hit, farmers in several states received notice that their processor contracts were being terminated, sometimes with only weeks to find another buyer before their milk had nowhere legal to go. Some farmers found new processors in time. A lot didn't, and dairy farm closures accelerated sharply in the years that followed, with Wisconsin alone losing hundreds of dairy operations in the surrounding period. The cows were fine. The milk was fine. The business collapsed because of a single point of failure 3 steps removed from anything the farmer actually controlled. And it wasn't a one-time shock that resolved itself. The bankruptcy triggered a scramble across the entire regional supply chain, other processors absorbing what farmers they could, co-ops reorganizing overnight to pick up displaced members, and a wave of forced herd liquidations from farmers who simply ran out of runway waiting for a new buyer. Some of those farms had been operating, uninterrupted, for over 100 years. A single corporate bankruptcy 3 states away ended them in a single season. That's the real risk baked into this industry. It's rarely bad milk. It's almost always bad exposure to somebody else's balance sheet. So how do the wealthy players avoid all of this? They stop being a single farm and start being infrastructure. Large dairy groups own multiple facilities spread across different regions and different processor relationships, so no single contract loss can sink the whole operation at once. Some vertically integrate, building out their own processing and bottling operation, so they capture the markup a processor would otherwise take, sometimes tripling their revenue per gallon by selling branded milk or cheese directly instead of raw commodity product. Others treat the land itself as the real asset, buying dairy-zoned farmland not primarily to farm intensively, but because agricultural land near expanding metro areas appreciates steadily and carries tax advantages regular investment property simply doesn't. For these players, the cows are almost a side character in a much bigger real estate and infrastructure play, and the milk check is closer to a rounding error than the point. Let's put real numbers on a good year versus a bad one for that same 200 cow operation. In a good year, milk averaging $22 per hundredweight, strong component pricing from well-bred cows, decent cull and calf revenue, maybe $150,000 from a digester if they've invested in one. Gross revenue can land around $2.4 million. After feed, labor, vet care, and debt service, that farm might clear $150,000 to $250,000 in genuine net profit. Respectable given the risk and the hours involved. Now the bad year. Milk drops to $14 per hundredweight, which has genuinely happened more than once in the last 15 years, sometimes for stretches lasting a year or more. Feed costs stay the same or actually climb because corn prices don't move in sympathy with your milk price. Gross revenue on that identical herd can fall to $1.5 million. After the exact same fixed costs, because cows don't get cheaper to feed just because milk got cheaper to sell, that operation can post a loss of $100,000 to $300,000 for the year. Same cows, same acreage, same labor. $400,000 to $500,000 total swing, based entirely on a commodity price the farmer never had any real say in setting. And there's a third scenario that doesn't show up in most breakdowns of this business, because it's the one that actually ends careers instead of just eating into profit. Stack a bad milk price year on top of a drought year that spikes feed costs at the same time, which happens more often than you'd think, because both are tied to weather patterns that move together, and that same 200-cow operation isn't looking at $300,000 loss anymore. It's looking at $500,000 to $700,000 underwater in a single 12-month stretch, on an operation already carrying millions in debt from the entry cost. That's the scenario that turns a 100-year-old family farm into a bankruptcy filing in under 2 years.